Hello and welcome to the Outlook by STRAT. Mike, today we're talking labor market, recession concerns, Fed rate cuts finally coming, and we'll wrap it all up talking politics and checking in on the presidential election. First, let's go to the labor market, looking at jobs added, 3-month moving average here over recent history. Somewhat potentially concerning slowdown, at least at the headline level. What's been going on with jobs?
The August employment report showed 142,000 jobs added. That was a little weaker than expected. We were hoping for a nice weather-related bounce back that ultimately didn't materialize. So if you just look at the BLS data right now, what you're going to see is 3-month moving average of monthly non-farm payrolls added at just 116,000. That's not healthy enough. That's below just about everyone's estimates as to how many jobs we need to create in order to absorb growth of the labor force.
Yep.
So that's kind of the scary part. We think it's important, though, to make some adjustments here, given all of the revision noise and cross currents that have been happening to labor market data recently. One, of course, was the QCEW revisions, which is another scary thing, the 1-year period ending March, it turns out 818,000 fewer jobs were added than originally reported. That's the initial estimate. We don't think all of that is true. A lot of that 818,000 that the BLS is saying they're going to take out of the jobs data shouldn't be taken out. Those are most likely immigrants with pending legal status that got thrown out just due to the nature of the revision. So we think about 500K of those 818K should not come out of the data. The other 300K or so, we think that's reasonable to take out of the non-farm payrolls data because that was probably just overestimation from the birth-death model, saying a lot of new businesses were being created and adding a lot of jobs. And we've shown in our deep dive previously on the labor market that just wasn't happening. So that's how you see this light blue line. That's the first adjustment, that QCEW data. And when you take that into account, what you say is the slowdown isn't as significant, right? Because you were just starting from a lower point.
Right.
So maybe you take some of the shock off of it. But then you also see the August effect. We have to make an adjustment for August. What is the August effect? Everybody knows about it. The BLS has a lot of problems seasonally adjusting non-farm payrolls for August. If you look at the last 30 Augusts, the August number has been revised up 24 out of the last 30 years, on average by 53,000 payrolls. So we would expect something similar to that as well. So you make that adjustment and now trend job growth isn't as far off. But still, this is not healthy. 134,000 jobs added per month, a pretty material slowdown. Understand why there's some cause for concern.
Yeah. Not as bad as the headlines suggest, but still not in a great place.
Yep.
Right. You talked about not getting that August bounce back that we thought we might have seen. That August report led to the SOM rule remaining triggered. Mm-hmm. But as we talked about in one of our recent videos, we don't use the SOM rule for recession signal purposes. We use initial and continuing jobless claims. And you can see in the dark blue line here, initial jobless claims kind of leveling off a little bit and kind of help ease our concern around the labor market a bit.
Absolutely. And, this measures the rate of change. It's stalling out. That's great. If you just look at the absolute levels of initial jobless claims, the 12-week moving average is 235,000. That's not particularly concerning. And last week it was 227,000. So not concerning. So you take these two slides together and what it says to us is, the problem is that the U.S. economy right now is struggling to absorb sort of the final innings of the immigration boom that we had in 2022 and 2023. There are still folks that came into the country looking for jobs. They're having trouble finding them. What we're not yet seeing is what's far more worrisome and is more recessionary, which is a layoff spiral.
Job losses.
Seeing job losses that lead to lost wages and income, which lead to less demand for goods and services in the economy, which beget more job losses. We're not seeing that, thankfully.
Yeah. So you take some of these themes together and we check in on our recession signal, and not surprising that our recession signal remains inactive, right? We just talked about the labor market signal, seeing some yellow, some signs of weakness, but not particularly close to a level where that would trigger. Yield curve signal remains the one signal that is still active. We've heard from clients and viewers about the 10-year, 2-year uninverting and how exciting that could potentially be. We don't use 10-year, 2-year in our model here, and it is somewhat popular for that to uninvert right before a recession. So not particularly reliable. But how about on the real economy or market stress signals? Anything that's giving us pause right now?
There's going to continue to be some orange in these numbers for at least the next few months. So we're not going to have the all clear maybe until December or January at the earliest. And markets right now clearly are not stressed.
Yep.
So the economy is not in crisis mode. Our recession signal is not active.
Yep. Economy not in crisis mode. Markets not stressed. But the federal funds rate still remains healthily above neutral, right? So it continues to beg the question of why hasn't the Fed cut yet? When are they going to cut? And what's it going to look like once they do start cutting? Mm-hmm. And what we've got laid out here are kind of new versions of our landing scenarios. What do these different landing scenarios look like now that we appear to be very close to starting a cut cycle?
Yeah, absolutely. So first thing is, we said before, we think they should have cut in June and July. And we thought at least 3 rate cuts this year. And we got feedback that was a clownish view. So now that seems to be, that is absolutely consensus.
Yeah,
so
much more reasonable.
Much more reasonable. So the Fed's meeting next week, they're going to cut.
Yep.
The question is, how big is the first cut? That's question number 1. Are they going to go 0.5%? And we think no, because in the past, just institutional inertia here.
Yeah.
In the past, rate cuts larger than 0.25%, emergency rate cuts, intermeeting rate cuts, all of those things have been reserved for 2 types of scenarios. One is there's an immediate crisis, think COVID, think global financial crisis, banks failing, or you're seeing layoff spiral. You're seeing 400,000 initial jobless claims every week.
Yeah.
Neither of those things are happening right now. We think they're not going to cut 0.5%. It would send the wrong signal to the markets and the economy. The second question is, because they're releasing their quarterly summary of economic projections and their dot plot, are they going to guide the market to a full rate cutting cycle? And we think yes. What does that mean specifically? If you look at the end of 2025 projection for the Fed funds rate, the Federal Open Market Committee is probably going to have something around 3%. Which is basically the neutral rate or the natural rate of interest.
Yep.
So that scenario is our immaculate landing. They cut 0.25% at every meeting from now through next September. That gets them right around the neutral rate, and the economy doesn't go into recession, but it also doesn't reinflate, and everything's hunky-dory. Not saying it can't be done, it's just never happened before. We would assign about a 30% chance of that happening from here. The next one is, of course, the hard landing. That's our least probable scenario that we assign about a 20% chance of happening. There, you start to see the layoff spiral that everybody's fearing, and the Fed has to react much more quickly, and they start doing chunky cuts, 0.5%, 0.25%, 0.5%, and get the Fed funds rate to something well below neutral by the end of 2025 because they're trying to revive the economy, and we go through a recession. And then our highest probability scenario is the no landing. So what does that look like right now? Well, if you look at how the Fed has behaved previously, if they're going to cut once, they're going to cut 3 times. They've never done less than 75 basis points worth of cuts. So let's just say September, November, December are in the bag. If they weren't going to do all 3, they probably wouldn't even do September. So that's going to happen. And then given how far away they are from neutral, they're probably going to follow through and do January. But the question will be, how sensitive is the economy and inflation to 3, 4 interest rate cuts? Is the economy so sensitive that we could be, doing these video shoots next January, talking about how core inflation is coming back up, the economy's heating up again, and the Fed might want to pause, take a step back, and maybe wait on further cuts. We think there's a reasonable chance that happens.
Yeah. And to that question of how sensitive is the economy going to be to this first set of potential cuts, we have reason to believe that it might be more stimulative than the hikes were contractionary.
Yep.
Looking here, household debt service ratio, essentially how much are Americans spending of their disposable income on debt, in a pretty healthy spot, less than 10%, which is right around, if not at the lowest levels we've ever seen as a cut cycle is starting.
Exactly. And that says to us, households have the capacity to take on more debt. They just don't have the willingness because the price tag is too high.
Yep.
If debt gets cheaper because the Fed's lowering interest rates, on the margin, you could see how that would be stimulative. Consumers could react to that. You contrast this to 2008.
Right.
It didn't matter. You could have made debt free. You could have put the price tag down to zero. Consumers had too much debt. They didn't want any more. It didn't matter. Rate cuts were not stimulative. It could be very different this time around. The last time that the Fed started a rate cutting cycle when household balance sheets were anything near this level of health was in 2019. Jerome Powell, the Fed, they did 3 cuts that ended in November. And the consensus coming into 2020 was that those rate cuts were stimulative enough that we should get a recovery in economic growth led by the consumer. That ultimately didn't pan out because COVID happened, and it's just one data point, but you can see the logic here. They have the capacity, just not the willingness. Then you look at other transmission mechanisms for monetary policy. We look at money market fund assets. They're over $6 trillion right now. That's about 21% of nominal GDP. That's the highest level outside of a recession in history. So why is everyone hiding out in money market assets? Well, you get a nice yield.
Yeah.
If that yield goes down, could a lot of those assets be recycled into other investment opportunities or the real economy? We think that's highly plausible. And then you think about the interest rate sensitive areas of the economy have been beaten down the most during this rate hiking cycle. Think about housing.
Right.
How sensitive is housing activity going to be to a 1% reduction in interest rates? We'll have to see, but I mean, everybody here I'm sure everybody can see sensitive. Potentially could be quite sensitive. You could have a lot of activity in the housing market. So, yeah.
Awesome. Well, if that wasn't enough uncertainty for us, we do have elections coming up.
Yep.
In the U.S. here in particular. So let's check in on our presidential election prediction mechanisms here. This slide looks very different than the last time we looked at it when Joe Biden was still in the race. It was basically just various shades of red in this rightmost column. Looking a little more balanced now, but pretty darn close, especially depending on the measure you look at.
Absolutely. It looks like there's more blue, but this is anyone's race. And so what we're questioning right now, it's still early. So what we're really looking at is, are market participants being complacent about this? Are they sort of all positioning for one outcome? Those types of things would be worrisome to us. If everybody's positioning for one outcome and it doesn't happen, that's when you get volatility.
Yep.
You don't get volatility when everybody's prepared for anything. And that's more of what we're seeing right now. If you look at the volatility futures curve, the VIX futures curve, volatility futures are very expensive right around the election. It's clear investors are hedging, they're reducing exposure, they're prepared for anything. And so, that's healthy. We think that's important. And you can totally see how after the election, if almost regardless of outcome, there's an opportunity to reduce those hedges, put money back to work, get money invested. We're also seeing on the corporate side evidence in earnings calls that a lot of companies are just postponing major CapEx decisions until after the election. Not necessarily wanting any particular outcome, but just, hey, let's just pump the brakes on this until after the election. So you could see more activity there post-election as well.
Yeah, and if we see both of those things, those being rate cuts being more stimulative than expected, and the uncertainty from the elections being removed, those could both be catalysts to put us into phase 3 of the Great Rotation here. We've talked about phase 1 and phase 2. What types of things would phase 3 entail?
Phase 3 probably has the most legs to it. You could see the catalyst, as you just pointed out, over the next 3-4 months. And you think about the potential here Russell 2000 value is still more than 20% below its long-term trend. If it catches back up to trend over the next 5 years, you earn a little over 14% annualized return, versus NASDAQ 100 is still, 35% above
Right.
trend. If it catches down to trend over the next 5 years, you earn less than 2% annualized. So there's plenty of room to run here, especially if that no landing starts to play out.
Right.
There's a nice little runway, 3-4 month runway, for the election uncertainty to dissipate. Perhaps you get a benign or even stimulative election outcome combined with rate cuts that are more effective than most investors are thinking, and you're off to the races.
Yeah. All right. Well, that will do it for this edition of the Outlook by Cap Strat. If you have any questions or comments, please feel free to reach out.